The stochastic stock indicator is a momentum indicator which is supposed to be able to showcase switches in momentum, switches in trend. As you can see from this image, there are two lines, one being the fast length, one being the slow length. Those are averages, which the fast keeps up with the shorter number of bars and the slow covers a larger number of bars, much like a lot of other indicators. And it is very commonly taught that when the fast indicator crosses from below to above the slow indicator, that is an oversold momentum switch. That's the indication coming from oversold to switching to up, and vice versa. When the fast indicator crosses back below the slow, that's overbought. It's very, very commonly taught to buy the cross above, sell the cross below. Today, we're going to utilize code to test every example of this happening across multiple time frames, across multiple tickers, to see if the indicator is useful and to figure out its best use case.
In a world where money is all that matters, people look for any reason to profit. Which way is best? Welcome to the indicator trials.
Hopping into the charts now just to show you how the indicator looks in Thinkorswim, which is the platform I trade with, the platform I code in to do this testing. I want to just show it to you all in here. So the red line is the fast length. The purple line is the slow length. I should have also mentioned in the intro, there are oversold and overbought conditional lines, these horizontal lines, the cyan horizontal lines at 20 and 80 as well. We'll take those into account as we do some further testing. But here's an example. The indicator should be buying here when this crosses, and it should be selling here when the fast crosses back below the slow here on this bar. This is one of those kind of picture perfect examples you see in textbooks, but what we want to do and what you need to do, not worry about perfectly hand chosen examples, test every single time it happens to get a real idea of if it's a way you should trade. So I'm going to jump into the code now, turn it on, and we'll look at the results. Okay, so back on the same graph, you can see the code is now working. 100 shares of SPY, or whatever ticker we choose to look at, was entered here. After the cross, the fast crosses the slow, and then it was exited here after the fast crosses back below the slow. It does exit the close of bars. That's a slight limitation of Thinkorswim, but you would need to do that anyway in order to prevent repainting. You wouldn't know until the bar closed whether the Stokes fast was actually under or above the Stokes slow anyway. So that is that. Now, if I go ahead and add the floating P&L, because once again, this is just one kind of picture perfect example. If I go ahead and add this, we will see the P&L from every trade. We are currently looking at 180 days of a 5-minute chart. So a large sample size. Will actually get into how many trades it's looking at in a second. And you can see trading this way, once again, buying when the fast crosses above the slow, selling when it crosses back below the fast, is up $1,000. Now, that is in no way a profitable edge over the market. I'll say it again. I'll probably end up saying this in every video. When we're looking at these single indicators in the indicator trials, we're looking at these single indicator tests. It's not supposed to be a trade strategy, right? The floating P&L is more so there to measure the usefulness. Not that I think if I just trade this way that I expect to have a market edge. You should never expect to be able to just use one indicator and have a market edge. It'll never be that easy. I'm sorry to tell you. I wish it was. Life would be grand. We'd all have Ferraris. We don't. It's never going to be that way, but it's a part. The stochastic can be a part of a trade plan, and it's important to study the most useful way to utilize it in a larger trade plan, right? So this is just a comparison tool more than like, oh, look at how much money it's up, as we look at other ways we could use this. So on the 5-minute 180-day on SPY, it is up over $1,000, but it takes a lot of trades. If I go ahead and click this show report here, it's actually taking a while to load. It's taken 1,000 trades. It's taken 1,015 trades in 180 days. This happens a lot, where you get that, cross. It crosses a lot. So it's taking a lot of trades. That's something to consider with this strategy. Now let's go ahead and flip around. So this is more kind of your day trades, your 5 minute. Let's go ahead and look at the daily using this for swing trades. As you can see again, well, first off, it's up 10 grand, which isn't bad, but it's also SPY. We've gone from 244 to 367. Let's just call that what is that, 120 points? That would be 12 grand up if you just bought and hold. So even with all these trades, it's still not outperforming buy and hold over the last 5 years. But once again, it's taking a ton of trades. And a concern you have for this indicator on swing trading is that it's not really avoiding the downfalls, right? It's not really avoiding the downtrend. It's still like, obviously we're in a bear market currently as I'm making this video, we're in a bear market and it's still catching a lot of losses from this. Quite often, if you look at swing trade indicators, they will slightly underperform or maybe just beside match like the buy and hold, but what it provides to you is large downturn protection. Obviously buy and hold, you have to hold through this whole COVID dip. You have to hold through this whole thing. So other indicators will help avoid the higher max drawdowns that come with the buy and hold strategy, which is important too. Strategies aren't just all about how much money can you make. Your drawdown, your bankroll management, your money utilization are all important factors into a strategy. I'm not going to get too deep into that right now. That's for another video. But this is something that on the daily, the stochastic even really doesn't help with, at least trading in this way. So let's go ahead and go back to the 5 minute, 180 day, and let's just flip through some other tickers. Let's look at Apple. It is down $1,900 the last 180 days on Apple. Microsoft, it is down $1,200. Tesla, it is up $8,800 on Tesla. Target, it is up $1,300 on Target. Okay, that helps give us a little smorgasbord across a couple of other tickers. Now, I want to change it now. A way a lot of people will teach or talk about using this strategy is only longing when the cross happens, also in oversold, right? So when the fast length crosses the slow length under this 20 horizontal level, under the value 20. So if I go into my code, I actually already have this, so it won't be too complicated. If I just uncomment this, that should happen now. If I go ahead and hit apply on this code, by the way, here's everything we're going to look at. If I go ahead and hit apply on this code, now the strategy should only be taking trades when the fast crosses the slow and it is below the oversold condition, and it still exits the trades when the fast crosses back below the slow. And as you can see on SPY, this actually gets way worse. It's now down 4 grand. Once again, not that we care about how much it's down, but just that it's performing worse. But let's also look at how many trades it's taking. It should be taking way less trades, right? Wow, it's taking way less trades. The other strategy, when we were just taking it whenever, took over 1,000 trades, 1,015 trades, if I recall correctly. This one's only taking 152 trades in the last 180 days. So you at least have much better money utilization this way, only buying, only using this to buy when it crosses below the 20. So you have much better money utilization. I want to look at the swing. I wonder if this does a better job of protecting against downtrends on the swing. Oh, wow. You actually, on SPY, you hardly ever get to enter because SPY's been so dang strong in the last 5 years. It's actually only one trade. It only buys the bottom of COVID because that's the only time you got this cross below oversold on SPY. Let's go to max available instead of just the last 5 years. Really? Okay, there's been a couple more trades, and it's not really super useful on the daily. Okay, waiting for that oversold condition is not super useful on the daily. Let's go ahead and flip back through the same stocks on the 5 minute, 180 day. Apple is now down $3,100. Microsoft is down $2,600, so seems to be underperforming. Tesla, which was up 8K the first time, is now down 18K. And Target is now down $830. So it seems perhaps only taking it when below oversold condition, not the best. Now, I want to jump into the next thing. The next way this can be taught, next way this can be looked at, okay, you're only buying when it's in oversold conditions. Now, let's not wait for it to cross back below. Let's sell when the fast length gets above the oversold condition. So if I come in and tweak my code slightly, I already have all this set up. I just have to comment it out correctly. So let's get the right sell code running. Now the sell code is sell stochastic full K. Full K is the fast length, full D is the slow length. It'll now sell when the fast length gets above 80 and it's still buying the cross. So let's see if this makes it any better. So now the code is, you see how it's sold here, instead of waiting for it to cross back down, it's sold here, but the code on SPY is still down $4,000. If we go flip around just again quickly, Apple still down $2,000. That doesn't seem to help much. You can see we're pulling pretty much the same numbers here. We're pulling very closely the same numbers. It doesn't seem to help much. It might even make it slightly worse, selling when the fast length just gets above 80 rather than waiting for it to cross below the slow length. So that might have gotten even a little bit worse. Do not remove all studies, please. The next thing I want to look at, let's go ahead and not worry about the cross anymore. I want to buy when the fast is below the oversold. So instead of waiting for cross, it is now just anytime this red line, anytime the fast length goes below the oversold 20 condition, which is the condition out of the box, it buys and it sells anytime the fast condition gets over 80. So it doesn't care. It's actually not looking at the slow length, the purple line at all. Literally just looking at the red line. I feel like I'm talking about this kind of fast. Like I can catch myself rambling a little bit. Please, if you have questions, you're like, Trey, what the hell? What did you just say? Let me know in the comment section down below. I'll do my best to help clear it up. But for now, we're looking at just the red line, crossing oversold and selling overbought, and as you can see, it's performing even worse, down $7,800 on SPY, down $700 on Apple. I think that's actually doing a little bit better on Apple. Microsoft is actually green. What is Tesla? Tesla is very red, and then Target is more red than it has been before. So this does seem to be slightly worse. If we flip over to the daily, this should have more trades on the daily. It does, but it's performing way worse than just trading, buying the cross, selling the cross, trading much worse than that. Now, what if we try the same thing, the same idea, but with the purple line, with the slow line? Buy when the purple line goes oversold, sell when the the purple line goes overbought. If I jump into the code again quickly, once again, it's already all set up. I just have to comment out this and then uncomment out this. We are now running the full D, which is the purple line, the slow line, buy below 20, sell above 80. Let's go ahead and run this. And it actually, so it's still down. It's still not doing as good as the very first one did. It's still down $3,700 back on the 5-minute, 180-day chart of SPY, but it is performing better than the fast line was. Let's go ahead and flip through quickly. Apple, up $2,500. Microsoft, up $3,500. Tesla, down $30,000. Wow, careful, Tesla. I mean, obviously Tesla's an expensive stock. It's going to throw more money around, but wow, that's a big change. And Target is also red. Let's go ahead and flip to the SPY daily. Look at how it does on swing trades. It doesn't take very many swing trades. It's actually only taken 3. It did win. That's good to see. You know, maybe it's a rare condition, but when you get that condition, it can work. Let's look at max available. And let's go ahead and scroll. Okay, well, you don't expect anything to always work, but it certainly did not work here. Bought never quite got to oversold until all the way down here. So that didn't work very well there. So it seems to me, first off, I don't think this indicator is super, like it hasn't been as useful, as structurally sound as the, I don't know what that means, as structurally sound, but as useful as the RSI indicator was that we've already done one of these videos on, and the MACD indicator that we've done one of these videos on. The stochastic does not seem to be as strong, does not seem to be as helpful as those two to me. Let me go ahead and turn this back to how it first started. I think the way we ran it when it first started looks to be the best utilization of it. Now, once again, for everything, do not just go trade like this because it takes a ton of trades. It takes way too many trades when you just buy the cross and just sell the cross. But it showcases that that part of the strategy can possibly be utilized alongside a larger trade plan, right? It seems to be the best way that the stochastic indicator works. Once again, not just cherry picking a single trade. Oh, look at how good this works. Buy, sell, wow. But looking at every single instance, this has 1,000 trades. You're getting 1,000 trade backtest. That is the beauty of utilizing code to backtest. Is you get an immediate backtest. It would take you a month to run this for each one of those conditions if you were doing it by hand, but you have to test all the conditions. I will preach that every one of these videos. Stop just looking at pictures like I showed in the beginning. I don't know where the picture went actually, but the picture I showed in the beginning that just shows you like a picture perfect couple of examples. You have to look at every scenario it happens. You have to do real back testing. You can't just look at the times it works. So that's what the point of this series is. That's the indicator trials. Hopefully you enjoy it. Now, we've done 3 indicators. This is stochastic. We've done MACD and we've done RSI. The next video, I'm going to look at the best way to combine those 3. That's kind of how I want to do it. We've done 3 momentum indicators now. So I want to kind of combine the momentum indicators, see if we can put together some sort of trade strategy with those 3 momentum indicators. And then we'll jump into kind of the next set of individual indicators. That's kind of the way I want to do it. Lay out 3, 4, 5 individual indicators, wrap them together. Lay out 3, 4, 5, and then we can start to, within this series, kind of build potential strategies, build potential trade plans with what we've learned from utilization of the individual indicators along the way. So hopefully you guys are enjoying the series. I really am. They're a blast to make. I think this is really, really, really useful information. So hopefully you guys are enjoying this. If you are, hit like. If you're new around here, want to follow along, want to see the videos in the future, hit the red subscribe button. With that being said, I'm going to go ahead and sign out of this video. I will catch you all in the next one.